on today's News Talk, TNT Radio.
Right. Now, as I keep on saying, I love talking about the economy. I used to be head of trade statistics and business inflation at the Office for National Statistics, here doing statistics on the economy for the government in the UK. So it is one of my favourite topics. So I'm delighted that I've got somebody who understands all of this stuff. Her name is Rebecca Walser, and she is the president of Walser Wealth Management and best-selling author. Welcome to the Freeman Report, Rebecca.
Thank you so much for having me, James. So glad to be here.
Yeah, thank you for joining me. I'm going to start on a technical thing because I think it's a good place to start if we want to have a conversation on the economy. I saw on X that you've posted about this. I am talking about the yield curve and the fact that it's been inverted, and we've actually just broken the record, which was last set in terms of the number of days it's been inverted back in 1978. I wonder if you wouldn't mind, because there'll be lots of people watching this who are thinking, yield curve, what is that? And what does it mean when it's inverted? I wonder if you wouldn't mind just, first of all, explaining what the yield curve is, and then why it's significant that actually it's been inverted for so many days now.
Yeah, so a yield curve is just really a graphical representation of how yields are moving over time. And we usually take 2-year treasuries and we forecast them against 10 years and even the longer duration 30-year bonds. And we're showing how the 2 years are, placed in relationship to 10 years and 30 years. And basically what we normally expect, and I'll try to do a really good job. I tried to explain this to my girlfriends, James, recently, and they're like, we still don't understand. So I'm going to really try to make this as, how hard it is to explain these concepts. But the basic bottom line is to understand that banks basically normally, maybe not so much in the last since 2020, we've had some changes there, but normally prior to the 2020 coronavirus situation, banks make money on what we call yield spread or interest rate spread. Their job is to lend money out to consumers and to businesses, either commercial or, retail credit. And so basically how a bank makes money is that they are borrowing in the shorter term with lower rates, and they are lending money out for longer terms. And because they're lending you money for 10 years or 30-year mortgages and commercial loans and those types of things, those rates are higher because they're locking up their capital through your loan for longer. So they expect, because of duration, a longer loan, they have to have a higher return. And they make the difference between what they're borrowing at the short term, 2 years or less, even 90 days, if we're talking treasuries, over the 10-year or the 30-year. And so that's how normal operations work. When you have an inversion, that is a non-normal situation, and that's when shorter term rates are actually higher than longer term rates. And because the Federal Reserve raised rates so abruptly, so much, when we went on the rate hike path, that we went through, short-term rates are higher, and because the market has expected that those rates must come down. And really that's where the problem is, James, is that the fact that we have, at least in America, very much been conditioned to expect that normalized rates are really what we call lower for longer. The Fed really maintained what we call the rate at 25 basis points or 0.25% for close to 15 years. And so we had really small or relatively low long-term rates. And as I'll wrap this up. Basically, as we've had really low rates for so long, as the Fed raised rates, short-term rates are actually higher than the basket of all the long-term rates. And that's a problem because now banks cannot make a spread. They cannot make money. And that causes all kinds of liquidity problems. It causes all kinds of lending problems, which leads us to, all kinds of long-term capital problems. And that's what we're seeing right now. We have just under $1 trillion of commercial real estate that has to be refinanced this year in 2024. Some of those loans, James, were pushed from 2023 into 2024 because, let's be honest, the regional banks did not want to recognize losses by basically having to reassess the values of those properties and then relock them into much higher rates that really the borrowers can't afford. So they would have to realize losses. So they sort of said, we think the Fed's going to cut rates in 2024. Let's push some of these, let's work out some of these loans to refinance them next year. And as rates have not yet been cut, we're starting to see more and more liquidity problems for banks.
Brilliant. Absolutely brilliant. Very, very well articulated there, Rebecca. Perfect. What I wanted to lead on to is I've had lots of guests recently on the show that have talked about the fact that there's a large number of banks that are underwater, i.e., they're not sustainable at the moment with rates. We know that the Fed keeps on indicating that they want to cut rates because it'll help make this problem better or easier to navigate for banks. But then we've also got the problem of inflation, haven't we? Which is the reason which the Fed is saying, well, inflation's got to come down. Also, if we drop rates again too quickly, then we might have other bubbles like in the stock market or the crypto market. So thank you for that. I think it's kind of put things into context very, very nicely. I guess then my next question for you is, are you worried about the US economy this year?
Well, I am absolutely worried, and I don't want to be hyperbolic here, but I do believe this is sort of this is the perfect setup if we were going to ever see the end of fiat for the US dollar, and really globally as well. There's a lot of global macroeconomic factors that are part of that rationale. But if we just look at the United States and what we call our monetary policy, which is the policy that the Federal Reserve implements. And everyone thinks the Federal Reserve is a government agency. It's not. It is an outside central bank that is not supposed to be a part of the government and is supposed to operate in what we call the open market, because it is not supposed to be directly operating and controlling the money supply. So it's supposed to operate through third-party commercial banking, which is private, which is how it's not a government entity, to really control inflation. Their two mandates are to control inflation and employment, keep unemployment low and keep inflation at a 2% benchmark. And so what we have here is what we would call a traditional classic catch-22. What happened was, it really is, James, and you know exactly what I'm saying. What happened was we decided in 2008, and it really began under Bush with the TARP, the Troubled Asset Relief Program, and the concept that your listeners and viewers will remember of too big to fail. These banks did create toxic assets. They created asset bubbles, but they're too big to fail. And if we let them fail, the entire economy will collapse. And that was true. Let's be honest. So basically what they decided to do was stop the bleeding, stop the collapse by stimulating with more capital. And so what we really entered into was what we call modern monetary theory in this country. That kind of economic monetary theory says that the government can really, and when I mean the government, I mean through the Fed and the Treasury operations, they can really continuously print additional capital dollars and stimulate the economy. And as long as they can collect enough tax revenue to service that debt, there should be no problem. But it's not true. And it works for a while, like it has. It has sort of kept us on this. If you look at the market from 2008 and onwards, with a few little blips of years as an exception, we have pretty much seen a stock market that has gone super hyperbolically up. And people have made a lot of money and everyone's thought, this is great, until the reckoning comes. When you have a 2020 event where globally the equivalent of 20 trillion US dollars, now not in the US alone, we did about 7 to 10 in the US alone between fiscal policy and monetary policy, but the rest of the world and their own domestic currencies also printed. So you have the entire world shutting down and printing a ton of additional money, and that money has to get absorbed into the system. Now, inflation is a very simple concept. There is a finite, limited set of goods and services. They are not unlimited. So there is limited supply. And when you create a lot more demand by inflating your money supply globally, that forces prices to go up, because now we have a lot more dollars chasing the same amount of limited goods and services. That's what inflation is. And so as we started to see inflation, the Fed said, oh, let's raise rates because that's their standard MO for combating inflation. Decrease economic activity, demand will drop, and therefore prices will drop. Go ahead, James.
Yeah, so I was going to say, so no. I think that you're articulating everything really well there. I guess what I'm thinking of is, look, it's an election year in the US. You've rightly said, the central bank is supposed to be separate from government, but we know that a lot of political pressure can be put on central banks, and that's generally what happens, right? You know that. Yeah. So I'm wondering if, because it's an election year, we are going to see rates cut at some point this year. That will fuel some of the bubbles which are already out there in property. Yes, it'll make it easier for the banks, but because we have got this topsy-turvy sort of economy with all these contradictory indicators at the moment, like low employment, high inflation, banks underwater. It just, the stock market all-time highs all the time. These things don't seem to make sense when you look at them at face value. But I do wonder if we will see a strong economy this year. And then we will see some kind of problem afterwards, which Trump, if he gets in, has got to pick up. Because look, at the moment, every 100 days, $1 trillion is being added to the national debt. It's unsustainable, isn't it?
Yeah, and that's exactly the point I'm trying to make here. We are, I believe, already at the precipice of a breaking point. And I don't believe that we will get through 2024 with a great economy. I believe that we are scraping by month, and that we really are at the edge of the end of fiat. And fiat basically meaning that everything is derivative off of underlying core hard asset values, but there is no real relationship there anymore. And we've done this to ourselves, and that's that catch-22. When you literally stimulate for 15 straight years and you have almost next to zero lending, what happens is you do create asset bubbles. You do get a lot of more development. You do get a lot more people doing things. And when you start to raise those rates and those debts cannot be sustained at much higher rates, then you start to have the banks underwater, you start to see liquidity problems, and that's when you're going to see some type of collapse. And as far as the Fed being apolitical and not raising rates, in the 8 of the last 9 national elections, we've had the Fed change policy. So I do expect the Fed to change policy, but I don't expect to get a lot of rate cuts. We see the Wall Street Journal coming out today saying, we might get 1, 2, or none this year. And you've got less now than, you've got about a 46.1%, according to CME Group, of a June cut. If we don't get a June cut, James, it's going to be really hard to get 3 cuts in this year.
And Rebecca, we've only got 3 minutes left. So this might be an unfair question, but I'm really keen to hear, what would your advice be to people watching this now and thinking, oh my God, how do I protect my money? Because, if all of this does happen, then we're going to, there's lots of different things that can happen. But what would you say people need to be doing with their savings now to protect those?
So I will tell you, because I do believe that we are sort of at the end. I don't know how long the end will last, but I believe that we are at the end of what we call the fiat system. And I see the world moving towards the east. We are no longer unipolarity with just the dollar as the reserve. We are multipolarity because we have the BRICS bloc now. And if you look at the BRICS bloc, which is Brazil, Russia, India, China, South Africa, now all the others that join at the beginning of this year, 2024, you've got more GDP in the BRICS nations than you have in the G7 of the West. And so because of that, we are at the end of this. This is a shift. This is a global shift. You can see the demise of one currency and the rise of another alternative. This has happened multiple times in modern history. And anytime that happens, the go-to assets are always our commodity metals, specifically gold, silver. And so if people believe, as I believe, that we are on the tail end and the beginning of a global transition away from the dollar's not going anywhere, but it's not going to be the sole reserve currency. It's not already. It already isn't.
And just one final question in the last minute. Are you an advocate for the new digital gold, Bitcoin, or do you think that no, traditional metals are the way forward?
I do believe in crypto. I do believe distributed blockchain. I don't believe in CBDCs at all because I think that's a government controlled tool of people. It's not true money. So I do believe in the non-government CBDC, but I will say that it is still speculative, and I wouldn't bet all of my entire wealth on that because it is new and we haven't seen it go through a global transition. So I would use that as a speculative part of portfolio and not as the main part.
Fantastic. Rebecca, listen, I'd love to have you back on the Freeman Report. You talk my language. I love chewing the fat on what's going to go on. And I think you're absolutely right. I think the real golden rule in investing in anything is not to put all your eggs in one basket. Make sure you spread your risk across lots of different investments. Rebecca Walser, ladies and gentlemen, thank you, Rebecca, for coming on the Freeman Report.
Thank you, James.
Thank you. Right, okay, I'll be back tomorrow, but don't go anywhere because we've got more great shows right here on TNT.